August 25th, 2023. Whenever you have a sell climax, which yesterday was, there's a 75% chance that the next day is going to have at least 2 hours of sideways to up trading. So you can see on the daily chart, we had a big sell climax. Obviously, on the 5-minute chart, you can see it was a giant sell climax as well. So you have 75% chance of 2 hours of sideways to up trading, which is the same vice versa. So if you have a giant buy climax, 75% chance of 2 hours of sideways to down trading. You can see we got a leg one, leg two measure move from bar 10 to bar, oops, 10 to 14, and then the market traded above 14 on 15. So that's the end of the first leg, and then pulls back, and we get the second leg down to bar 18, which, it's hard to see the two legs, but you just think of it as one. And then when you get the pullback, that's the start of the second leg. That's where it is. It's also an expanding triangle open, so increased chance of a lot of sideways trading today. Sorry. As usual, and I talk about bad signal bars or magnets. You can see 34 was a magnet, and you can see on 41 when we tested down to 34, it was likely that we were going to get back to that high, and so that's why a lot of traders, anyone who sold above 34, is disappointed in 35, 36, and those traders got trapped, and they were likely to get out at around break even, which they did on 41. And similarly, if you bought below 40, you're probably going to be able to get out at break even. So we're probably going here, but then once we get here, we're probably going here. So a lot of those traders exit the market and get back here. And kind of that's the same reason why I think 30 happened. It didn't quite test the 23 high, but it got pretty close enough that a lot of traders would consider it tested. So if you sold above 23, which isn't the best signal bar, a lot of those, but it was a reasonable stop entry. A lot of those traders sold more higher, and they were able to get out around break even. And you notice the only traders who didn't get out were the ones at the beginning of the trend. So, you had trap traders above 52. And when you get trap traders, it can lead to trends in specific contexts. And I'll talk a little bit later about why I think, a trend here was a lot more likely than a trend here. Bar one, bull bar, but selling pressure on the high. You can see that when we get 2, 3, and 4, there's 3 straight dojis. They're essentially dojis. I know they're not actual dojis, but they're essentially dojis. And when you get 3 dojis on the open, especially this fast, it's probably going to be a trading range day. So you should be pretty careful buying breakouts. And in general, just so that's why, I wouldn't sell below bar 5 because you're in the middle of a trading range here. And bar 6, it's potentially a double bottom and maybe a buy, but there's often a report at 10 o'clock. And so the market can move pretty violently. But some traders will buy. But I think if you do buy above 6, you probably want to have a wider stop. So you can buy more below 6 if we trade below, since it's probably still a tight trading range. 7, outside up, sellers above, buyers below, which is expected in a trading range. And we got a failed breakout down on 8, and then a giant bull bar on 9, but 9 is at the top of a trading range. And so I think that's why 10 is an okay sell, because you're selling more towards the middle of the range. It's a giant bull bar, or bear bar, so you're probably not going to get to sell at the top. But it's a reasonable short below 10. I think you need fast follow through though. Like if you get kind of a doji bar on 11 or something like this, I would probably just get out. But you get, surprisingly good follow through on 11. So we might have to get back to yesterday's low. And some traders will sell below 11, just hoping that we continue down. And we do continue down on 12, 13. But something to keep in mind is that traders who bought below 8, because they're probably going to buy the breakout point, right? Traders who buy below 8 could buy more 5 points lower on 12, and they were let out at break even on 13 or 15. So bull limit orders are making money. So this might not be as strong as you want it to be. Additionally, there's a lot less. There's still tails here, and there's a tail here, but they're generally smaller tails. And so here, this is big tails, not closing below its midpoint, kind of a doji bar here. And, with yesterday being a sell climax, it's just lower probability that we're going that much lower today. So where was I? Yeah, 11, good follow through, traders sell to close. Kind of bad follow through on 12, not really what you're looking for, but still okay to be short. You get follow through on 13, probably buyers below, to be honest. Like it was likely we were going to get a bounce here. I was surprised that, we found sellers above 14 so quickly. There probably should be sellers above 14, but I was expecting a more sideways move rather than a second leg down. 15, outside bar, closing near its low. We're now basically around yesterday's low, so we're probably going to get below it, which we do on 16. And then, we started to have open gaps, but it's pretty climactic. It's either the close of this bar or the low of that bar and the high of that bar. And follow through 17 and 18. Reversal attempt on 19. Pretty low probability reversal. In general, reversals are 20%. So, or just any given bar has a 20% chance of reversing the trend. So, back here, buying above 14, you probably have about a 20% chance of this trend just reversing and going straight up. And, buying above 19, kind of similar, you have about a 20% chance of this reversing going straight up. Now, most of the time, 4 out of 5 times, this is going to happen. This is going to happen. So it's just better not to just take those trades. But every once in a while, you'll get lucky, like on bar 19, and you just get big follow through. So the problem is, though, if you're going to buy above 19, you pretty much need to make most of what you got there to make up for just the sheer amount of times that you're going to lose taking that kind of trade. But you can see bears start buying back shorts above 19 pretty aggressively, and you get big follow through on 20. I thought we would get back to the 19 high, but you also have to keep in mind that 20 is strong enough to make the market always in long, because the bulls should get a second leg after 20. So even though the bears should get a second leg, the bulls should also get a second leg. 21 doji bar, probably buyers below, probably sellers above. You can see any trader who sold above tried to make money on 25. I don't quite think they did, but they were able to later. Buyers below 22, you can see it was probably around, I haven't checked, but yeah, probably around a 50% correction, which is pretty common, especially since, you get a spike like this, but this is probably going to get another leg sideways to down. So traders, instead of buying up here, they'll buy at a 50% correction and be willing to scale in lower, even if we touch the 19 high or go below 19, knowing that we're probably going to get back to this low. 23, bull bar closing near its high. Some traders will buy, citing that 19, 20, and 21 deserves a second leg, and maybe we'll get that second leg and get above at least the 21 high, potentially higher. It's also probably a spike on a higher time frame, 19, 20, 21, so you could get a good, some sort of follow-through bar, some sort of second leg. And 24 is a surprise bar for sure. You can see it didn't even trade a tick below the 23 high, and it just raced up immediately, which is pretty much, if you're buying with 23, you pretty much need it to race up, because a lot of times you'll get kind of a bad follow-through bar here. You don't really want to deal with a bad follow-through bar. But something that 20 tells you is that it's probably a trading range. You already know from the stuff cited earlier that it's probably a trading range. So when you get 20, bar 20, that it's even more likely it's a trading range. So buying above 23, you might be buying low in what is probably a trading range. You generally want to buy in the lower third. So, you're in that lower third. So it's reasonable to take that buy, hoping we get back to maybe the open of the day, which is about where we got to on 26. The open of the day is pretty much always a magnet on trading range days. And today was Friday, so you have to keep the open of the week in mind as well. It was 43.95 right here. We oscillated around it for an hour or two. So big fall through 24. You can see 25. When you get 24, if you bought over 23, you're pretty thrilled, and it's probably a trading range. So a lot of traders will just take the 15 points and get out. And you got a third push up on 26. So 1, 2, 3. So it's a parabolic wedge top. And the traders who sold above 25 are probably going to make money, which they do on 27. So it could be a bull trend. It's very possible, but you also have to keep in mind that, it's potential parabolic wedge top. And bears who sell, well, first off, it's not smart to sell this top. And you get some fall through 28, and then you get 29. So bears shouldn't allow, or bulls should not have allowed 3 straight closes against them if this was going to be a bull trend. And you can see we got 3 closes against against the bulls, and then basically once bulls see 29, they're extremely disappointed, and they'll just dump the rest of their longs, and that's why you get this, because any bull, bulls will hold through 1 or 2 bars, but once you get a third, a lot of them are disappointed and then just immediately dump, flatten at the market. And that's what a lot of times will you get vacuum tests of this kind of stuff. And disappointment's pretty common in trading ranges. So when traders get disappointed, they'll often flatten their position pretty quickly, and it can lead to climactic moves against you. 31 inside bar. I wouldn't buy. I think this is good enough for a second leg down, which is what we got on 34. 32 fall through for the bulls, but again, this is strong enough for a second leg. This is kind of the reason why this, makes me think that this is not going to be that strong. So even though we got, 3 straight bull bars here, and then we potentially have trap bears above 34, to me, this looks like a wedge and then 2 legs up. So I think that, after this reversal attempt is probably going to fail, and that 35 and 36 is probably just a second leg trap from this, because of this. Whoops. So versus over here, you have two legs down and you had a bull bar in between. And so you have kind of more buying pressure splitting it up. So you don't necessarily need to get, another leg down for the bears here. Versus here, this is pretty strong. So the bears might have to test the 30 close because that's where some bears got trapped and it was reasonable to sell that close. We flipped always in short. So that's kind of why I thought that, this move up was probably weaker than this move up. And it's kind of hard to get long in here. Maybe you buy above 53, taking a chance that we rally, but you end up, it was said yesterday to me that you got to sort of just in general in the trading room that you have to be able to live with a lot of uncertainty. You have to take a lot of trades amidst uncertainty. When you're looking at 53, you probably think, well, maybe we're going to get a little higher. Maybe we'll get up here. But you also know we're probably going to test the 52 high. And then you get 54, where you can see, okay, well, now we have bull bar with follow through. And, traders who sold up here are pretty unhappy with this. And so you start getting more and more follow through. And at some point, you just kind of got to buy the market. Let's see. 37, it's a high two, it's a low two short, but probably not all that good. 38 outside up, possibly a third push. So you have 1, 2, 3, pull back 1, 2, 3, and then a sell below 30 or below 39. The thing about selling below 39 though is that this bull channel is relatively tight. Even this is especially tight, but this whole channel in general is somewhat tight. So there's probably, and you got to think about it. Like when you see 39, how often are you just going to get a big collapse on 40? Really not all that often. And so you get bad follow through 40 and traders see 39, bad follow through 40. And then when they get 41, they see it as a gift to scalp out at 34 high. And so that's what they do, causing 42. You could buy above 42 thinking maybe we have to get back to the 9 close because it would disappoint the bulls. You also have to keep in mind that the 10 low was a reasonable stop sell. And so that's one of the reasons we got selling pressure here. And you can see we failed to break out of yesterday's high, or the day's high. Basically, we tried, but we failed, which is pretty common in trading range days. And sometimes there'll be a failed breakout and it'll just get vacuumed back to the open of the day because it's a trading range day. And that's a pretty common magnet. You could buy above 42, but if you do, what are you thinking on 43? Is that the follow through you wanted? No, you wanted another bar like 42. And so a lot of the traders exit at break even during 44. I think 45, you probably need more confirmation. Maybe you're going to get a good bull bar and good follow through, but I would just rather wait and let that happen. If 46 closes on its low, maybe it's an okay sell, but you get follow through 47, but there are problems with this tail. And, you're probably at the bottom of, a potential smaller trading range. And there was, what's the best case? You're getting to a 30 low. So it's kind of difficult to want to sell 47. Your risk reward isn't all that good. That's your 1-to-1. And I don't know, maybe 60, 70% chance we're getting here. I don't know about all the way down here though. So, and the thing is, if you get here, there's going to be buyers. So you need to take at least a piece off. So that's why you get traders on 48, basically taking profits below 47 rather than selling below 47 like they would in a trend. 49, 50, a couple of bear bars. 49, probably buyers below 48. Doing that. 50, inside bar, but I probably wouldn't sell below 50. I think it's just 2 legs down, potential second leg trap. And it's a tight bear channel and it might deserve a second leg, but this was also pretty tight bull channel. And on a higher time frame, this is, probably a weak breakout on a higher time frame, but still enough for a second leg. So I would be pretty careful about selling below a bar like 50. I just think you're selling the bottom of the bear channel line, and it's just not that much left to it. Then you get a big bull bar 51, and you can see it's probably just bears buying back shorts. And then on 52, we trade down. Any bear who sold the close of 50. If you sold the close of 50, what are you thinking on 51? That sucks. Like, I'm really disappointed in 51. So on 52, those traders buy back their shorts. And any trader who was still short and decided to hold through 52 will probably just buy back their shorts at the market once they see 52. And that causes a big bull bar on 53. Some traders will buy above 53, taking a chance that we rally. Maybe if they're lucky, we get up here, but probably not. You end up getting follow through 54, and bears are expecting to get back to the 52 high. More follow through 55, doji. And again, still thinking we might have to get back here, but bears need to get a bear close. 56, another bull bar. And this is where, we have a couple of straight bull bars. We're probably, even if we start to trade down, we're probably going to get another leg up. So even if we start to sell off, traders will buy here and get a second leg up. So traders will start buying. You see we get 57, 58. These tails on the bottom mean on smaller time frames, this is probably more of a broad channel. So, it's better to classify this, I think, as a tight bull channel than it is as a breakout. But you can call it either. But you could argue that this is a tight bull channel. Because on a lower time frame, it's probably actually a tight channel on a. Well, let's look. Let's take a look. 205 to 220, we'll call it. 205 to 220. Yeah, so pretty much tight channel here and then started to break out. Follow through 59, 60. It's pretty overdone though. We have a lot of bull bars and it's getting more climactic. But we might have to get up here. Follow through 61. You know that this is enough for the first reversal to fail, so traders will keep buying. So 62, 63, a couple of bear bars, yeah. But right as, bears start to have an argument, if bears get one more bear bar here, that's a big problem for bulls. So chances are they're not going to get it. And bears get disappointed in 64. But any bull who bought in here is disappointed in 62 and 63. So both sides are disappointed, probably a trading range. Follow through 65, 66. Probably testing this close. Probably some sellers there. See, we got sellers at a new high, 67. Buyers below 67, 68. Sometimes we'll get back up above it and retest that breakout point, but you can see that we tried twice, and generally when the market tries twice to do something and fails, it goes in the other direction. You can see we failed to break out of 10 on 67 and failed again on 72. And so that's one of the reasons we got 2 legs down here. On Monday, it's a potential, 3 pushes, 1, 2, 3. So we broke out below the wedge, and it's potentially 3 pushes, and bulls might look to buy. If this closed better, they'd probably definitely look to buy, but it didn't. So we'll see. The weekly chart, I think eventually, within a month or two, we might have to get back to this low. But I think this is enough damage that we're probably not going much higher because, this is kind of similar to this. To me, it means we're probably in a trading range. And yeah, that's really it.